Hi everybody, this is Gary Dean again with Sentiment Timing, and in my previous video I showed you how Woody Dorsey was able to predict exactly when these markets were going to reverse weeks in advance. And the main thing that you really want to know is you just want some type of advantage over your competition. And being that the stock market is a zero-sum game, meaning that for every share that's bought, a share is being sold. So once you make a trade, that's your competition, because somebody's either selling you a share and wants it to go down, or they're buying your share and wants it to go up if you're shorting. And the main thing is, if you know with confidence that a top is coming weeks before it took place, then you're going to be able to, just even if it goes in the wrong direction for you in a little bit, with confidence that you have a big drop that's pending, And that's what I'm going to go over in this video, is some of the recent calls that took place. So I'm going to start with some of the previous ones, and this was on September 9th, 2014. The black hole predicted 2 weeks earlier the S&P loses 200 points. So this was on our September 9th newsletter. He had said that he was looking between the September 18th and the 22nd, and he was calling that the black hole. And from this, that the S&P topped on the 19th and dropped 200 points. So from that, this is that drop right here. He was saying that, he didn't want to come anchored to it, but 1013 is a date to start looking for a low. So as you remember, when the market's heading up, the media and everybody's bullish on the markets. They're not looking lower. And if you're able to anticipate these moves, you're positioning your portfolio. If you're a financial advisor, you're telling your clients not to be buying this rally. You want to wait a couple weeks because the low is going to be coming in. You're going to get referrals left and right if you're just sitting there and not even timing the small moves. I'm talking the big moves that have taken place, because every one of them has been predicted weeks in advance. So this was the 13th. He was said that the 13th, don't be anchored to it, but a low should be coming. The low came on October 15th, and it rallied 260 points. Again, selling when everyone's bullish, buying when everyone's bearish. So now this is the February 26, 2015. He was looking for declines from March 4th into the 11th and then rally, and it equaled 159 S&P points, because this was the March 4th. It dropped 82 points into March 11th, and then rallied another 77 points. So there's another 157 points. And this would be one of the smaller ones where I'm saying you may not want to, if you're a financial advisor, telling your clients to weave in and out. You want the big ones, and they're identified. You know when the big drops are coming well in advance. But if you're a hedge fund trader or you're managing money, you know what? Taking 159 points in a matter of a couple of weeks is not a bad type trade if you're positioning your portfolios correctly. So on June 16th, 2015, S&P topped on 622 and drops 87 points. So on the 16th, he was saying that it's going to be the week of 622. That we're going to get a drop. You can see we dropped 87 points there. On August 4th, 2015, S&P drops 240 points, and this was predicted 2 weeks earlier. This was that kill zone trade, and you can see this was when the report was giving. You would have known, as the market's rallying and all the media is bullish on the stock market right here, that you want to be positioning your portfolios on the downside. A financial advisor telling your clients to maybe put some stops in place and then be buying when it's down here. These are the types of trades that make you millions of dollars if you know what's going on. These are the types of market timing calls that, if you're a financial advisor and you're letting your clients know this, that you're going to get referrals coming left and right, because everyone wants to know what you know. So the last one we have here is September 17th. The S&P drops 140 points, and that was predicted 2 weeks before. This was on the 3rd, our September 3rd newsletter. He had said it was that there was it was a volatility around the 17th. That was, everybody was bullish on this market. It was the Fed meeting. The market rallied. on the 17th and then dropped 140 points. So again, if you are looking for any type of advantage in this market, instead of just a buy or hold or short and hold and you're really going nowhere, you want to be in the market at the lows and you want to be out at the highs. And this is really the trading advantage that you've been looking for. And it doesn't make a difference if you're a financial advisor, a hedge fund owner, or you're managing money. Knowing exactly when these big drops are coming, even if you take away all these little ones, these just big drops alone could make someone's year, basically. And that's really what goes on. So if you're interested in changing the way you look at these markets and trading with confidence, I definitely would take advantage of this $99.99 special we have.